Winston and Felix here, and the following concepts are so important to understand. I thought we'd make a bit of a break here from our little beach trip. And the reality is that the big investment banks on Wall Street send out at the end of the week a report with what they see coming to all of the big fund managers, to all the big guys on Wall Street. And of course, you and me typically don't get their hands on it, but thanks to Winston's connections, we actually do. So I've got here for you about 8 pages of notes I've taken from the weekend notes of Goldman Sachs and JP Morgan and all the other big banks, so that you are actually the best informed investor out there and you can make better decisions going into this week, going into this month and further ahead. Winston, you're a bit of a camera hawk, aren't you? So let me walk you through it. And you might want to take notes, you might want to take screenshots. I'll try to do this in an orderly way and put the sort of headers on there and add the charts as well, so it really makes sense. So the first thing is that everyone's going to be talking about in the next couple of weeks is the yield curve. And yes, he's a little hot, but he can go for a swim in a second. And what does it mean when you have an inverted yield curve? Well, it basically means for the last couple of years, we were in an environment where we thought the near future was terrible and the long term would be better than the near future. Sit down, sit down. Good boy. Oh, so sweet. And right now, that's an inverting. It's an odd concept. But every single time that's happened, it meant that we were expecting the economy to move from a phase of growth to a phase of stagnation or recession. So it's been an incredibly accurate recession indicator for the last 50 years, 2000, 2008, and so on. And that indicator is flashing warning signs again. So does that mean we should go and panic or stick our beautiful tongue out as much as this guy? Let me walk you through that, because there's a little bit more to it. If you want to really master the skill of managing your money, and I'd highly encourage you to, because it's the one thing that's given us freedom. It's not the jobs, it wasn't the businesses, it's actually mastering how you make your money work for us. Then come and join our bootcamp on Tuesday. It's completely free of charge. It's not intimidating. I assume zero knowledge. All I'm asking is you give us 2 hours of your time and we'll teach you and show you how it really works and how we're up like 80% so far this year, plus another 20% of unrealized gains. So we're doing quite nicely. But let's just look at the market picture here for a moment. So for the most of this year, everyone's been complaining that the rally was only led by a couple of stocks and the rest of the market was kind of floundering. Well, right now we've got, what, 89% of the S&P actually in rally mode. So the rally is broadened, surely a good thing, right? So that's a positive here. Isn't that a positive, Winston? I think it's a positive. And who's buying these stocks? Who's driving the rally? It's you. Yeah, it's you. And maybe Winston. Because individual investors have basically massively bought the dip. Winston, come on, stay here, mister. Come on. Excuse me, you're kind of in the way. Bottom, Winston. You get a picture of a large bottom there, sorry about that. It is a rather nice bottom though. You can go and sit in the shade if you like. So active managers on the other hand, so the fund managers, they haven't gone full in yet. So that could be a positive because it means there's still money on the sidelines, right? So take a note of that. And then we've got something scary coming up, seasonal. So September is historically a horrible month. If you look at the performance from Labor Day to the end of September, all the way back to the 90s, basically the market drops a percentage point on average. Not a huge drop, but still a drop. And as I mentioned though, mutual funds haven't put all their cash in. They are not as exposed. Their cash allocation is actually at an all-time low. Hedge funds, however, are not extreme. So hedge funds could put in more money. The mutual funds probably can't because they're kind of out of money. So, okay. So now we're thinking, where's the money going to come from to propel the rally? Now we're worried about September. Lovely, isn't it, Winston? Well, there is a silver lining here. The market is less short. Why is that a good thing? Is that a bullish thing or is that a bearish thing? Well, again, it depends on how you look at it. You could argue that this bottom means the bottom represents the shorts. It's a rather large bottom. If everybody's short, they can't get much more short, and therefore it's likely that the market will improve. And when they are not short, like they are right now, you could argue that they could get more short. So they're a little bit cautious going into September. But there are some optimistic signals as well, and I will round this up all for you. I just want to throw some data points at you and then explain them. Winston, not helpful. Winston, come on, over there, over there, over there, over there. Sweet little bear, you. All right, so the algo funds still have stuff to buy, right? They're still going to buy. They're still at moderate exposure. They could significantly buy more, especially in the next week. It'll tail off into September, but for the coming week, there's still buyers. And overall stock positioning, which is called consolidated equity positioning, is at 0.5. So it's, yeah, we're all in stocks, but we're not at like 1 or something where we're kind of crazily into stocks and where it's the peak of the market and all is going to, go kaput. Why do you keep showing us your bottom, Winston? Why do you keep showing us your bottom? So what about sentiment overall? We were in the fear zone last week. Right now we are at 0.6. 1 is deemed stretch. This is Goldman Sachs's trend indicator. So we're kind of in like okay land, right? It could get better. We could go to 1, right? We could buy a little bit more. What about Bank of America? Well, they say that it's a nice bottom. They're saying that we're at neutral. We're at 6.1. The indicator goes from 0 to 10. So again, we're like in the neutral land. So nothing really to worry about. But, yes, this but. The consumer is what I'm worried about. You, yes, you. Your credit card delinquencies are a problem. We now have 10.9% of card debt balances are overdue for more than 90 days. That's not good, right? That's really not good. That means a lot of the consumer out there is overstretched and they're struggling. So why am I still smiling? Because the sky is blue and it's a beautiful day and this guy wants to go for a swim. There is a bull case here. If you listen to Goldman Sachs, they're saying, look, earnings could come in better than expected. Nvidia could knock it out of the park on Friday. I think they probably will. If the economy remains durable, largely because the US government keeps spending money, and the Fed is expected to cut interest rates by 2 percentage points in the next 18 months, that's all a pretty bullish setup, isn't it? Or a pretty butt setup. But you got to ask yourself, who is actually left to buy? Winston, come on a bit further over there. It's not very polite to show people your bottom, Stubborn little mule. Who's left to buy? Well, if you listen to, I think this is JP Morgan, 5 out of 6 Powell, Jackson Hole speeches saw the S&P drop 7.5% on average in the next 3 months. So now I've got you depressed, haven't I? So you got to ask yourself, who's going to keep buying this? Buybacks are going to save us until the 6th of September. After that, corporate balance sheets actually drop to more moderate levels where we're going to see less buybacks. And I put a chart on here for you as well. We're going to go back to sort of the 2008 lows of cash balances. But let me give you some final overarching thoughts and tell you also what we're going to be doing next week, aren't we? How are we going to be trading this? Okay, so the earnings beats that we've had over the last year have come in a little bit smaller over the last quarter than in the previous 18 months. So it kind of implies we're peaking-ish, right? The forward premium, which is basically by how much are the Magnificent 7 stocks undervalued, that's going to come down a little bit. So it's not going to be quite as bullish or buttish. Winston, we talked about this. I can't do anything about this golden retriever. Sorry about that. While the AI rally, Winston, come. Hey, come. While the AI rally has got us all very excited, we are now more appreciative that it might take longer and we might not see massive gains immediately. And he's trying to sabotage us. You see what he's doing, right? And I think that's a good thing because I think expectations have calmed and therefore we have a more meaningful likelihood to actually beat it, right? I'll just use them as a desk. So with all of that on the table, honestly, I'm still a fan. I still think the big tech stocks, the Magnificent 7 stocks, are going to do very well. I think the AI rally is still got juice in it. And just look at the NASDAQ. The NASDAQ's gone up 15 out of the last 16 years. So why the heck would I bet against the market? Because It doesn't make sense, does it? Does it make sense? Winston says, come on, put a cork in it, put an end to this. So what are we going to do in terms of trades? Well, we're going to keep going with our themes. I think industrials are still a theme we're making money on. I think financial banking stocks are still making money on. And yes, we're still going to do some tech trades. I think the whole crypto space is going to come back because with falling interest rates, it tends to. You can do that through crypto. You can do that through the miners, whether that's CLSK or Mara or whatever. This is not financial advice. I'm just telling you what we're doing. And I'm just going to still keep looking for what I think are undervalued great companies that have just gotten beaten up. Fintech is a sector I talk about quite a lot, whether that's PayPal or SoFi. I think with a longer horizon, we still have a lot of rally in those. So I think we're going to end this year as probably the best one yet. And if you want to join us on that journey, come and join us on Tuesday, felixprehn.org/bootcamp. It's bootcamp, isn't it? Not butt camp. And then we're going to take this guy and cool him down a little bit because he's very, very naughty. And if you enjoy our little roundups here, I hope the editor will do a decent job with the charts and it makes sense. If you have any questions, ping them my way. And of course, you can join me on Tuesday because we'll actually run a really nice long Q&A and you can ask me everything you've always wanted to ask me that's maybe a bit more technical or more strategy or whatever it might be. But honestly, just learning the skill of making money out of your money, it's what everyone's missing. See the guys back there with the yachts? I don't know if you can see them. I'll show them to you. They know how to make money from their money. Otherwise, they wouldn't have that yacht. Let me show you. Stay. Can you see those guys out there, right? They know how to make money from their money. This guy does too. So I thank you for tuning in. I thank you for watching. I wish you a beautiful week. Felix here. If you're worried about how far this market's going to crash and what's going to happen to your favorite tech stocks next week, then this is the video for you. We're going to run through Nvidia, the S&P, the Nasdaq, Palantir, Apple, Tesla, Microsoft, Neo, Alphabet, Amazon, Meta, PayPal, SoFi, maybe one or two other names we can think of along the way.